Hello friends, I am Kaustav Bishwas. Today in most frequently asked question series, I will discuss on question what is the impact of behavioral biases on investment decisions? Behavioral biases significantly influence investment decisions, often leading investors to make irrational or suboptimal choices. These biases have profound implications due to the unique socioeconomic and cultural environment. Let's explore the most common behavioral biases and their impacts on investment decisions in India. 1. Herd mentality. Explanation. Investors in India often follow the crowd or rely on market trends without conducting their own research. Impact. This can lead to bubbles, as seen during the tech boom of the early 2000s or more recently with the rapid rise in stock prices during the 2021 bull run. The fear of missing out, FOMO, often drives investments into popular stocks, sectors, or asset classes without sufficient analysis. 2. Overconfidence bias. Explanation. Many Indian investors believe they can outperform the market based on their own knowledge or intuition. Impact. Overconfidence can lead to excessive trading, underestimating risks, and over-allocation in speculative investments. This is particularly evident in the growing retail participation in stock markets and in areas like cryptocurrency and small-cap stocks, where investors often overlook the risks. 3. Anchoring bias. Explanation. Investors often fixate on a specific reference point, such as the original purchase price of a stock. Impact. In India, this bias leads investors to hold on to losing stocks in the hope they will return to the purchase price, or resist selling winners for fear of missing further gains. This can lead to missed opportunities for better investment decisions. 4. Loss aversion. Explanation. The pain of losses is felt more intensely than the pleasure of gains. Impact. In India, this bias often results in investors holding on to losing investments for too long to avoid realizing a loss, or shifting to safer investments like fixed deposits and gold, even when the equity markets offer higher potential returns. 5. Recency bias. Explanation. Recent events are given more weight than historical performance. Impact. After experiencing a bull market or high returns, Indian investors may assume such returns will continue indefinitely, leading to inflated market valuations. Conversely, after a market downturn, they may become overly pessimistic, as seen during the 2008 financial crisis or the early phases of the COVID-19 pandemic. 6. Regret aversion. Explanation. Investors avoid making decisions for fear of future regret. Impact. This often results in Indian investors sticking to conservative investment choices like government bonds or public provident funds, missing out on the wealth generation potential of equities and mutual funds. 7. Mental accounting. Explanation. Different money is treated differently based on arbitrary categories. Impact. Indian investors might treat bonus income, inheritance, or speculative gains differently from regular income, leading to different risk-taking behaviors with these funds, often investing windfalls in high-risk assets without proper evaluation. 8. Disposition effect. Explanation. Investors are more likely to sell assets that have gained value while holding on to those that have lost value. Impact. In India, this leads to premature selling of profitable stocks and holding on to underperforming assets, which can deteriorate overall portfolio performance over time. Socioeconomic factors in India. Cultural tendencies. Traditional preferences for gold and real estate still dominate, although equities and mutual funds are gaining ground due to greater financial literacy and digital accessibility. Retail investor growth. With the rise of digital trading platforms, retail investors in India have surged, particularly since the onset of the pandemic. This has amplified the effect of behavioral biases, as many new investors enter the markets with limited knowledge. Financial literacy. Despite improvements, financial literacy remains a challenge. Lack of understanding about financial products and market dynamics makes investors more susceptible to biases. Conclusion. Behavioral biases deeply impact Indian investors, influencing their decisions and often leading to inefficiencies in their investment strategies. The rise of fintech platforms and greater emphasis on financial education can help mitigate these biases, enabling investors to make more informed decisions. Disclaimer: investments in the equity market are subject to market risks. It is essential to read all relevant documents carefully and thoroughly understand the risks involved before investing. This content is provided solely for informational purposes and should not be construed as financial advice. For personalized financial solutions, it is advisable to consult with a qualified financial advisor, product expert, or product distributor. As registered financial product distributors, we do not charge any additional fees from our clients. Our remuneration is provided by the product companies. We distributed products which comes under regulatory frameworks. This effort is aimed at knowledge sharing, and we do not claim the completeness or accuracy of the content. Please refrain from making investment decisions based solely on this information. Thank you.